Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing, see what news they're releasing, and what people are thinking and following about commodities and the financial markets. Obviously, I'm going to interject my financial opinions all across the board on this. Again, they're just my opinions. And if you want to follow me on Twitter, it's at finding_finance. I do post some things up there. And if you want to join our community, it's finding-value.com. Love to have you a part of the community. We are running a discount right now. The coupon code is discount. So let's go in here. So it says high value financial advice given from investment wisdom from Morgan Housel. He says, spend less, save more, wait longer, lower your expectations. What has worked for me is I did this exact same thing is I spend less, I save more. I do wait and am very patient. And then I don't know if I'm lowering my expectations, but I'll just say this. I find happiness in things that don't cost a lot of money. But I do realize that the base cost of living is increasing and it's hard to spend less. I am greatly empathetic to that. And it's also harder to save more, conversely, if you can't spend less. But I think a lot of people where they get hurt is the wait longer. You're going to have to figure out how to be more patient and invest given the timeframes that the market generally returns investors. A lot of these investments, they pan out very well in a 3, 5, 6, 7 year time frame. That is where you get your gigantic big moves. If you're early, it's going to feel like you're wrong, and you're going to be going through volatility, like we are. We're very early in a commodity bull market. We've done perhaps the first wave, pulling back for a second wave. It may not even be the first wave, guys. This is maybe the first time I can talk about it, but that stimulus money may have created the credit expansion and created what I would consider to be a little wave in the beginning. Now that stimulus money is wearing off, and then the big move is going to come when the supply shocks the system. Whatever wave you want to call it, wave 1, wave 3, because maybe it's wave 3, and that's kind of how I view it, is wave 3. But maybe I'm wrong. Maybe it's only a lead-in pattern that we've got on this big move. Because if you look at a lot of the charts, and we'll look at some of the charts here together, they are very, very early on their ratio breakouts, which they have not moved on a wave 1 basis. So the stimulus money could have shocked the system, kind of jump-started it, created that big bottom, jump-started it off the bottom for wave 1, and then the wave 3 comes with the actual supply shortages in the market, which will be very long, very big move for wave 3. Here's Druckenmiller views per the FT. It says Fed overdid it with BTFP. I'm not really sure what BTFP is, but thinks stocks will be flat for 10 years, but volatile. I agree with that. So he's in our camp. He thinks that stocks will be flat, and that more than likely, if you think that, you're going to have an increasing interest rate environment. You'll probably have increasing precious metals and increasing commodity prices. He's in the hard camp or hard landing camp, and he's short the dollar. That will also be a tailwind for our commodities and precious metals. I think right now, if you were to look at any of the asset classes out there, I'm most how can I say this? I think that gold and silver and precious metals have the greatest chance of success in the short term. I think that the market conditions are aligning for a big move in precious metals. They're also positioned right on top of patterns. That's the exact spot you want to be for a big move. And they are moving in a way against other assets, which are all positive. So you've got the alignment that I basically look for in precious metals. That is not to say that the gold and silver mining companies, that all of those companies will outperform. They might. Maybe the money will rotate into gold and silver mining companies. Maybe you're going to have to be selective in the companies that you have to pick in order to do well in this next upcoming bull market. Another thing that I always think about is that the conditions may be ripe, just like Druckenmiller's talking about here. But what if there's actually shortages across the board of commodities? For, let's say nickel, copper, aluminum, et cetera, et cetera, et cetera, et cetera. Where do the miners fall in gaining and getting those materials, and at what cost? That is where I am unsure if the mining companies will outperform the commodity itself. So I have exposure to all of those things. I have exposure to the direct commodities, which I think is the least risky proposition, and probably one of the best risk rewards because the risk is so low and the rewards could be quite good. Or the mining companies, where they could have problems and the risks are much higher for a variety of different reasons. And some of the reasons I just listed there are a commodity shortage. What are they going to do if they can't get parts? What are the suppliers going to do to those mining companies and the suppliers of a lot of other companies? What are they going to do if they can't get the raw materials? That is where I get concerned. And someone will say, well, they'll just charge more and they'll somehow get it. I'm not in total belief of that, guys, because if there's a shortage of metals across the board, that means that all of those metals are just a derivative of energy. And if energy is the master commodity, and if that is where the shortage actually exhibits itself, then everyone's just going to fight over energy because all of these companies are more or less a derivative of energy. And that derivative of energy is going to be the lifeblood of their sole purpose or being or existence of those companies. So they're going to pay a lot to get that energy. And I think that's where the choke point could be, but you could also have a bunch of other choke points. You want to be invested in the things that are the choke points, because everything else will be in a surplus except that one or two or three things that are the choke points. This is nat gas in a long-term view. This is your energy supply, and I see this as a huge, huge buying opportunity. Obviously, I'm wired quite different because I take a longer time frame and a longer viewpoint than everyone else. I definitely nailed the 2020 bottom time frame. I rode it all the way up. I still hold my natural gas companies, which really haven't fallen that much. The natural gas price has fallen quite dramatically. I think this is just a retest on a much larger, bigger picture view. I also think that we could go vastly higher in a very quick manner if the right weather patterns and conditions show up. I know that sounds weird that we're basically relying so much on weather. Natural gas does. But if it does come back, I think this is a pretty good entry point in this general vicinity for natural gas. Natural gas is called the widowmaker, but it's also called the moneymaker. The moneymaker can make you lots of money in very short periods of time. And the natural gas equities generally are supercharged to the natural gas price move. I will say this, though. The equities are not as favorably priced as they were in 2020. They have not come back as much, and that relationship of the equities in relationship to the commodity price isn't priced as well as some of the other areas. But the risk has been sucked out of those companies as they've made quite a bit of money and their debts have been paid down a lot. So the risk reward is still very attractive, but I'm not sure if the risk reward is lopsided as it was in 2020. And this is natural gas zoomed in, and you can see that we're definitely trying to throw in some sort of bottom here. over time. Just be very patient with it. And if you're a long-term investor, it could be a very good return over the next year or two, depending on what the weather does. It could also go nowhere. That is also a possibility if the weather remains warm. Europe had a very warm winter, like the warmest winter in 40 or 50 years or whatever it was. So this is like it's an anomaly in weather that we had, which caused these prices, which was one of the leading factors of these prices going down like that. This is uranium's spot price. Has made a breakout to the upside after almost 10 months of sideways action. This is obviously, Uselink is posting this up, Casper, Rasmussen. We've got our trend line here, and we've broken that to the upside. So the physical market in uranium is moving to the upside. I did just have a discussion with Justin. He's talking about the underlying strength of the physical, we call it the physical metal. Uranium's a metal. And it's doing very well from the physical side. Now we're looking at the equities. The equities are still lagging, and they are very cheap in relationship to the commodity itself. In fact, they're as cheap as they were back in 2020. Could be a very good buying opportunity for those that are patient and those that have the willpower to stay with it and to undergo some dramatic volatility. I know there's a lot of negative sentiment in the commodity sector right now, and that's generally when you have the best buying opportunities, when everybody gets negative on it. Here's SRS Rock Report. It says U.S. Ponzi finance hitting the energy brick wall. Must see charts why energy and not money is causing economic havoc. After watching well-known financial analyst interviews this weekend, I realized just how unprepared we are as a human race. So this is United States oil consumption per capita versus the U.S. M2 supply per barrel of oil consumption. And what we're seeing is a dramatic, basically a hockey stick of M2 money supply per barrel of oil consumption. Wealth comes from consuming more energy. That's basically what it is. Whether you buy a new trinket or whatever you want to call it, that requires energy to make it. You can consume the energy directly by driving your car, riding on an airplane, going on vacation. You could be consuming it, heating your house, doesn't really matter. As your lifestyle increases, the consumption of energy goes up. And what this is telling us is that USA oil consumption per capita is declining. And we could see the M2 money supply go up per barrel of oil consumption, which means that basically he's charting the rate of inflation. If everything in the world is a derivative of energy, including food, including everything that you consume, and your M2 money supply grows at a faster rate than your barrel of oil consumption, that therefore is inflation and a problem in the system. The only way that you can kick that problem is if you gain efficiency in the system, whether it be technology or processing speeds, whatever it is. There could be some of that over a long period of time. I will definitely say that we've gotten more efficient at producing whatever it is and also gathering energy, gathering food and whatever else from our surroundings. But that is something to watch, and it's a big deal. So here's uranium as well. I said big bullish engulfing on the weekly and daily charts for uranium right now. Looks solid. Can the momentum continue on the Sprott Physical Uranium Trust? We've got this kind of squeezing up, and we've got a nice big bullish engulfing here that occurred today. This is on a weekly time frame, and we could go higher here. We've been squeezing on up. It is something to watch. That's not a prediction. I'm just saying that it's squeezing up. We've got a bullish engulfing. That's generally a good indication that the momentum is starting to move higher and that we could have a breakout. So that's one to watch. Yeah, and I did a interview with Justin. It said it would be pretty funny if everyone piled into treasury bills and they all defaulted. technically we are defaulting because we print money to pay all that off. It's not like we're holding the M2 money supply flat. I mean, it's come down and is actually running negative in the very short term. But as these things come up, all this money is just funny money anyway. I would rather store my wealth in physical assets and physical metals and physical stuff than I would in something that can be created electronically or digitally at a keystroke or a few keystrokes. That's just something I'm not really interested in. It says the biggest thing about making money is time. You don't have to be particularly smart. You just have to be patient. And I agree with that to some extent. In commodity markets, they work during a certain period of time, but you have to be patient for that period of time. It's not measured in months. It's not measured in weeks. And everybody tries timing the markets in the short term. And that's fine. You know, they can do whatever they want, but the rich guys don't time the markets in the short term. That is why I take these long-term viewpoints. That's why I do not trade in and out of companies. Yes, I may rebalance here and there in a blue moon if I feel that there's a better opportunity in the market, or I'm way too heavy in a certain sector and I need to rebalance the portfolio a little bit to make it a little bit better, actually a little bit more even balance between the sectors. But you have to have patience, period. You do not determine when prices go up. You do not have a control over the outcome. The outcome is the outcome, what it will be. And what you need to do is you need to become a student to identify what causes things to go up and down, what causes money flows to change, what causes the market conditions to change. And if you can identify market condition changes and you can identify money flows and how those things work, that is the value as an investor. But then you have to be patient after it. Things don't happen immediately. We've got my boy Scott here, Uranium. It says running into a very long-term resistance. Resistance after we clear this level is much lighter. Once we clear $73, $75, we enter the fly zone. That's for uranium pricing. Sentiment can turn on a dime. Don't know what will happen short term, but long-term picture is clear in my humble opinion. So we're up against some resistance here. That's what he's basically picturing. What he's saying is once we get above 73 or 75, that's that zone up here, the resistance, if you look at the chart as this, the way it fell, could be the way that it goes up. So when we go up, we get into these sticky periods where the price gets stuck at certain levels based off of previous trading. That's why it's gotten stuck in this general vicinity here, because we've got lots of people who've traded in history, and that's generally where people say, if it gets back to this level, I'll sell it. This is a bottoming pattern. You can see that we've definitely have higher lows, higher highs, and we continue to work our way up against that resistance. Once we break that resistance, we're into the fly zone, like he says. Totally agree with him. Good observation, good chart. It says, surely we're close. Another one from Scott. Past consolidations this cycle. 2018, 2020, 70 weeks. 2020 to 2021, 60 weeks. 2021 to now, 65 to 80 weeks, depending on how we measure it. So he's got these different areas of consolidation that we've done historically. And it seems like everyone kind of forgets how long these things consolidate. It's just the way it is. And in the beginning of the bull markets, they consolidate a lot. It's boring. It sucks. It's a hard ride because a lot of volatility happens in the beginning of the commodity bull markets. I said that in my beginning videos that I did in 2020 and 2021. I said, guys, at the beginning of the commodity bull market, it sucks. Why? Because you've got all these big pullbacks that happen in the beginning of commodity bull markets. You've got the bear trap that you have to go through as well. And I think some of the commodities are going through a bear trap. If you go and you look at natural gas, that's one heck of a bear trap. You go look at Newcastle coal futures, bear trap. Oil's pulled back from $120 all the way down to 60s, bear trap. Those are all bear traps in my opinion, but that doesn't mean they've bottomed yet. Do we have more downside? Do we still have a little bit more of a recession coming up? I don't know. And I don't particularly care because I'm just looking, hey, look, these are cheap. I'm going to cost average in a little bit. Yeah, I'm going to try to time my buys as best as possible. And that's all you can do as an investor. Some of these guys are really trying to time things. They think the whole market's going to collapse. These guys that are perma bears, I consider a lot of those guys perma bears, that they just think that things are going to collapse continually. Oh, interest rates go up, things will collapse. Eventually, yes, but that does not mean it's immediate. We could rip here in uranium. We've seen the breakout in the commodity price, and it could be immediate where this sentiment changes very rapidly, and you wake up and uranium's at $100 a pound. And you said, how the heck did it get there in a couple of months? That's what happens when things break out. That's what happens when you're impatient and you're trying to time the market. The market conditions are there for all of this to happen, and they could reflate the markets at any time. We don't know the exact timing. If they were to do that action, interest rates could go down, releasing more credit into the markets from the housing market. A lot of things can happen. A lot of things can happen. So, good chart there. Here's Tavi. He says, while the unemployment rate remains sub 4%, the number of permanent job losses has begun to rise significantly. The latest 2-month increase was as steep as every recession that has transpired over the last 30 years. The prevalence of layoffs in higher paying jobs has been increasing, causing a rise in the loss of permanent jobs. It is important to point out that the current strength of the labor market has been disguised by the ongoing demand for workers to perform jobs that are relatively lower skill level. The overall labor market is not as healthy as it seems. So you can see these financial crisis, tech bust, pandemic crisis, and we're already way up there at those levels. Now, the question is, people look at this and say, oh my gosh, look how much it's gone up. I look at it as, well, when is this thing going to turn? Because we've already gone a great distance, and maybe the recession is mainly behind us. That is yet to be known, yet to be seen, and will only be known when looking in the rearview mirror. But I'm looking at it like, well, we probably don't have that much longer to go. So maybe we're closer to the bottom than we are to some blowout crash bottom. But again, I always remain open. Maybe we do have a washout crash where you get another 2020 buying opportunity. Now, I don't know if that will happen. That is not my opinion. But some people are keeping dry powder in case that does happen. So coming on back to this, it says if employment drives tax receipts, so this is also tied to employment. If employment drives tax receipts, not asset prices, why would tax receipts be down this much with unemployment still strong, but SPX down 20% in 2020? It'll be interesting when consensus realizes the only things keeping the U.S. Treasury solvent was the everything bubble and 8% consumer price index. So that's tax receipts. And I talk about tax receipts. I talked about it, I think, in the early part of this about they need inflation in order for the system to survive from a state level, from a federal reserve, or from a federal level. And it deals with taxes and your tax receipts. It says Treasury tax receipts are now down 35% month to date relative to last year's levels. And this has to deal with taxing property, taxing stocks and bonds and all these other assets. If everyone's taking losses, they're going to even get less tax revenue. So we're entering a very interesting situation where tax receipts are declining and interest rates continue to rise, causing a large imbalance between interest payments and tax receipts. Coming on down here. So I already went over this guy here, so I won't go over that again. Here, I'm going to go over some quotes here. To master investing, you need to master your emotions. I agree. It says, as an investor, you love volatility. You love the idea of wild swings because it means more things are going to get mispriced. So we're going through that on a lot of these commodity stocks. We are looking for those mispricings where you've got value above price. If the value far exceeds the price, you are getting a good opportunity. That is what you need to become a master of. You need to master the mispricing in the market. And you have to buy when it's actually down. Those are the things that you have to do. So you have to, one, master your emotions, and two, identify where the value is and place your money in areas that are mispriced. That's why I created this channel, to figure out on a big overall scale what sectors are cheap and how they are moving against each other, and in what market conditions does certain sectors change, where they change those ratios and valuations, where the money starts to flow into it. It says, if you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing. It makes little things grow big, and big mistakes fade away with time. Risk comes from not knowing what you are doing. That's also very true. People who just throw money at things and don't know what the heck they're doing, it's going to lose money. It says people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. That's how I made a good chunk in 2020. Now, I had money in the markets at that time. I rode through it. I also had chunks of money that were not in the market. So yeah, you gotta not be scared. And you gotta hit the buy button at some point when everyone else is scared. That is a tough thing to do. It says waiting for the bottom is folly. What then should be the investor's criteria? The answer is simple. If something's cheap based on the relationship between price and intrinsic value, you should buy. And if it cheapens further, you should buy more. So that's Howard Marks, really, an exceptional investor. What he's saying is don't try to time the bottom. Cost average in. That's basically what he's saying. And that's what's worked for him. Now here's one from Charlie. It says, an intense interest in a subject is indispensable if you are really going to excel in it. The real key to making money in stocks is to not get scared out of them. And I think a lot of people, when things turn negative and you get negative sentiment, you start seeing losses in your account, you get scared out of it. You don't know what you own. You haven't done the homework. You don't know the fundamental basis. You have no thesis. You have no strategy. If you can sit down and you have no strategy, no thesis, nothing, you got to develop one, guys. And then it'll help you stay in those companies. It says spend less than you make, always be saving something. Put it into a tax-deferred account. Over time, it will begin to amount to something. This is such a no-brainer, says Charlie Munger. It says when stocks are attractive, you buy them. Sure, they can go lower. I've bought stocks at 12 that went to 2, but then they went to 30. So that's pretty cool there with Peter Lynch. I'm going to end it there. This is getting kind of long. But yeah, that's what I've got for today, guys. If you guys enjoyed the clip, definitely give me a thumb up. Subscribe to the channel. Subscribe to the website if you want to join our community. We have a platinum question and answer session on Saturday, 7 a.m. Mountain Standard Time. And I moved that from Saturday, 7 a.m. to Sunday, 5 p.m. to try to gain exposure to the most amount of people that are members. I can also do some trainings if there's enough interest in doing some trainings. And we'll talk about that in the next question and answer session to see what you guys need or want. The trainings are typically around technical analysis, but we can do whatever you want. Obviously, if I need to research something, or maybe I can try to get someone else in there as well, I can do that as well. So that's what I've got for today. We'll catch you guys next time. This is Finding Value.